Good evening, one and all. This is C.S. Sanjay Nikam, Regional Council member and Direct Tax Committee Chairman of WIRC. Friends, we are pleased to welcome you on this 9th September 2025, and we are welcoming you in the fifth session of Direct Tax Study course. You all are aware that our endeavor is to reach out to the last element of the professionals, and in that endeavor, we decided, our chairman, Ketan Sayasa, decided to he conceptualized this idea that we will go online for educating our members on direct tax. So welcome you all, and we'll start this session, fifth session of the direct tax study course, with respecting our alma mater and showing our gratitude to alma mater, and we'll respect the motto song of ICI.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you, everyone. Friends, as I told you, this is the fifth session of the 10 session study course on direct tax. And we have selected unique topics for these 10 sessions and also invited eminent faculties. And best part of it that you can attend it from your office, and good response we are getting. Today we have with us Bhavin Dedhia sir. He is going to deliberate his expertise on the TDS provisions for non-resident. If you remember, we started this study course with the TDS provisions applicable to residents, and now we decided to have the two different sessions for two different categories of the assessees. And today we have the Bhavin Dedhia sir, very renowned and young chartered accountant from Mumbai, to deliberate his expertise. Also, we have with us our experienced chairman Ketan Sayya sir, our vice chairman of the WIRC, Piyush Chandak sir, and secretary of the WIRC, General Savla ma'am. Also, we have with us our today's coordinator, Chanchal Jain ma'am. Every time we come out to welcome you in sessions, we have already explained the activities what we are conducting for you. Still, for the better understanding of those who are attending for the first time, because we have given the facility to the members that they can attend complete course or they can attend a single session as per their choice. So friends, Direct Tax Committee is working efficiently and regularly on this disseminating of knowledge on direct tax. Every month we have two sessions on help desk, that is Samvad Vishwaska. In that sessions, we invite queries from the members. We assign those queries to the experts, and on 10th and 24th of every month, we do that exercise for the members, and very good response we are getting from members. Also, we have this study course. We are conducting it on every Tuesday of every month, every week, and that way 10 sessions are assigned for this study course also. Also, we are coming up with one more study course on the Income Tax Act, which is upcoming upcoming act, and that study course also we are going to launch very soon. There are, and that way approximately 8 activities we are conducting every month. That means 2 activities every week. We'll request you to visit your emails. you are getting feeds and information about those activities. Also, there are many other activities we are conducting, and respective committee chairmen will brief you about it. And I'll request Jinal ma'am, Secretary of WRC, to share his views and activities with you. Over to you, Jinal ma'am.
Thank you, Sanjay sir. Friends, good evening to one and all. First of all, I would like to congratulate Sanjay Bhai for this fantastic course, for having this fantastic course under Direct Tax Committee. And friends, it is 6 months and 15 days. A new team has taken over under the dynamic and visionary chairmanship of CA Ketan Sayyas sir. And with the support of all regional council members, 21 of us, we have Vice Chairman CA Piyush Chandak sir. All of us are continuously working, and there are various initiatives. As Sanjay Bhai mentioned, we have Direct Tax Help Desk, and all of us are continuously working to take the flag higher. And there are various initiatives such as Bhagyoday, Niryat, so on and so forth. In this week also, on Friday and Saturday, we are having 2 days internal audit course at WIRC. I request everyone to participate. And apart from that, we have around 10 study groups, requesting everyone to come forward and participate wherever possible. With this, wishing you a very happy learning. Thank you. Thank you, Sanjay Bhai. Over to you.
Thank you, Jinal Ben, for updating us about the study groups. We appreciate your efforts also, because single-handedly you are running around 10 plus study groups at WRC, and your energy and expertise are very much helpful to all of us under able guidance of Ketan Sayya sir. Now I'll request Vice Chairman of WRC, Piyush Chandak ji, to come forward and brief us about his activities and his contributions.
Yes, thank you, Chairman sir of this committee, and thank you, Chairman WRC, Secretary WRC, the faculty, Bhavin sir, and the coordinator, Chanchal madam. Very good evening, friends. I can see the dedication of the members. Though we are into the midst of filing and deadline of ITRs on 15th of September, still we can see 30 plus members attending the virtual sessions. So it shows the dedication of our members towards the profession at large. And this is one of the practice, this is one of the quality which our CA profession is carrying. Whenever there is an updation, we are always in the pursuit of knowledge. My dear friends, as a Vice Chairman of WRC, and along with that, having responsibility of CSR Committee of WRC and Work-Life Balance Committee of WRC, I'd like to emphasize one thing, that even though we are under like a tremendous pressure to file and complete the assignments of income tax and returns of all the clients, no doubt and nonetheless, whatever it is there, but please keep in mind that penalty is being paid by client and not by you. So it should not take the toll of your health, toll of your family life and everything. So that is how please try to balance whatever you are doing, whatever we are doing for the profession and for our offices. But ultimately बोलते हैं ना कि जो भी हम कमा रहे हैं वो अपने और अपनों के लिए कमा ले, तो उसका हमने बराबर से एक ध्यान रख के बैलेंसिंग भी करना जरूरी है. And that is how this work-life balance committee is trying amongst the members to like develop various habits of health and to have mindful learning, mindful eating everywhere. So this is how we are trying our best, and we are welcoming the suggestions from the members for keeping up those activities. For CSR activity, we have recently launched an initiative under the guidance of our chairman, office bearers, and like even the secretary madam. And the name of the initiative is Seva Sarthi, wherein we are trying to prepare the list of eligible entities who are doing good work for the public at large. And I'll request again the members to take part actively. There are 3 ways you can take part in this activity. One, you can be the volunteer as an expert to like analyze and scrutinize the applications made by various NGOs. Second, you can refer various NGOs which you feel are eligible to get the CSR donation and you are doing actual work. And third, you can like be a particular person wherein you can source us and like help us to reach out to the corporates at large, wherein you have your connects who are willing to give donations to the eligible entities. So by doing this activity, definitely we are again trying to like increase the image of our profession, have our brand building as a CA for the public at large. We are helping people also at large without like even paying a single rupee from our pocket, but still bridging the gap between the corporates and between those needy people is definitely different and ultimate pious task in itself. So I'll request all of you to take part in that as well. Along with that, we are having various seminars and various publications also are lined up. We are again trying to get our old publication of WRC, 5-6 publications were there on GST on various different sectors. We are in that touch of the authors of those particular books, and we are getting those updated, and shortly we'll be like again republishing those updated different books all as well. So I'll request all the members to keep in touch with us, keep on visiting the WRC website, so as you should not miss out on anything. With this, I thank you for the opportunity, Chairman of the committee, and over to you again. Thank you very much.
Thank you, Piyush Bhai. You rightly explain your activities, and one important point I always take from you that you are heading the work-life balance committee. And being a chartered accountant, we are very much conversant about the balancing everything. The balance sheet of the life should be balanced with the wealth and health, and that is the biggest point we should carry over, because knowledge is there. We are using knowledge for others, but we should use this knowledge for our family and our health also. So thank you very much for updating us with activities. And now our main source of the energy and source of our guidance, Ketan Sayya sir. Sir, everyone has pitched in and share their views. अगर हम लोग में से कुछ बचा रहेगा तो सर you cover up and you guide us and guide our members also.
Thank you so much, Sanjay Bhai. I think, the worthy office bearers and you as a committee chairman, you all have shared good information. However, on record, I place sincere thanks to Bhavin Bhai for his valuable time being spent today on tax deducted at source for NRI. I think this is one topic which is gaining importance. We have been seeing that more and more returns of non-residents are being filed, and we have seen a lot of amendment happening in last few years on the front of non-resident TDS, TCS. And when we requested, of course, one of the major concern was that this month is full of the holidays, festive season, and due date. But Bhavin Bhai was kind. On the one phone call, he agreed, and out of his busy schedule, he agreed for this talk. So Bhavin Bhai, thank you so much for being kind to the Western India Regional Council and sharing your valuable thoughts, valuable knowledge with the members. When it comes to direct tax study course, I think this is one, unique idea. Whenever we were visiting branches, like a lot of people were saying that we are not able to attend the direct tax course, which is happening physically, the refresher course, which is happening physically. And Sanjay Bhai had listed, we were discussing that what is to be taken in DTRC. And Sanjay Bhai listed some 20 odd topics, and I had only 8 topics to be selected. So I asked Sanjay Bhai कि बाकी के 12 टॉपिक का क्या करेंगे, and he said that कि कुछ प्रोग्राम करते हैं. And then this idea came up कि why not these 12 topics are also interesting, why not have one online study course. And every time, when you discuss, when you talk to each other, I think a lot of new idea emerge, and that's how this idea also emerged, thanks to that discussion which happened one of the days in the earlier months. I think a lot of initiatives have been already talked. Let me just make mention of a new one, modified annual membership scheme. We have launched day before yesterday half yearly membership scheme just for 6,000 rupees. For half year, anyone can come and attend the all programs at WIRC, which are physically happening, and can have, discount for the seminars which are happening outside WIRC. Earlier, the scheme was at 9,000 and 10,000. As of today, since the time has lapsed of 3 months, now we have reintroduced for half yearly purpose, and the charges are 6,000 for female member, for senior members, and the newly enrolled member after 1/4/23. For rest of the member, it is 7,500. I think still the scheme is available at a hefty discount of 75%. If we all in all total up, the program which are going to happen in this 6 months are worth 30,000, and they are just offered at 7,500. One more interesting first ever RRC is happening. I did mention in the earlier session, at the cost of repetition, let me tell you that residential refresher course happening at Jaipur. It's one of its kind. We have worthy 2 paper writer on international tax as well as on transfer pricing. The 2 topic are FDI, ODI and basics of FEMA. one more paper we are yet to announce, which will happen on 12th morning. So 10th, 11th, 12th October at Jaipur, COE, first ever program happening at our own facility of ICA, Center of Excellence, at a very, very nominal price of 7,500 for 3 days ex Jaipur. So I request member to take advantage of the same. Friends, if you have any suggestion, as rightly told by our secretary, madam, we are just left with 5.5 months to do our best in the first year of this term. And we all 21 are committed to do good work for the ICI, for WIRC. If you have any suggestion, any other views to be shared with any of us, please feel free to contact us. Thank you so much. Over to you, Sanjay Bhai.
Thank you very much for updating us with the direct tax committee activities and other activities also. And we again invite you for this DTRRC, one of the unique program we are conducting at the Center of Excellence Jaipur. It's going to be very useful for everyone. So thank you very much, Chairman Sir, Secretary Ma'am, and Vice Chairman Sir for updating us. Now we'll move to the session, proper session today. Today's session, I'll request Chanchal, Madam Chanchal Jain. Ma'am, kindly come forward and introduce today's faculty.
Thank you so much, Sanjay sir. Thank you so much for giving me this opportunity. I'm very thankful. And I feel very happy to introduce our today's very learned speaker, CA Bhavin Dedhia ji. Bhavin Dedhia ji is a chartered accountant with over a decade of experience in direct taxation and is currently associated with Dhruva Advisors LLP, Mumbai, for nearly a decade. His practice spans direct tax advisory, domestic mergers and acquisitions, business restructuring, conversion to corporate entities, tax holiday undertakings, and tax litigations. He has developed significant expertise in reassessment proceedings and partnership taxation, including the application of sections 45(4) and 9(b) of the Income Tax Act. His sectoral focus includes the real estate and pharmaceutical industries, where he regularly advises large MNCs as well as some of India's leading business groups. He also regularly contributes as a speaker at CP circles and professional forums and writes articles on emerging tax issues, reflecting his keen interest in knowledge sharing and thought leadership. So with these words, I don't think this introduction is fair enough to justify such a learned speaker. Yet we are all here to listen to you, sir. Over to you. Thank you so much.
Thank you, Chanchal ji, Ketan bhai, Jinal, Sanjay ji, Piyush ji. I am indeed grateful to you for allowing me to speak at this our gathering in front of my seniors as well as juniors. I've prepared the presentation, and without much ado, I'll start with the presentation. Yeah. So my screen is visible, right?
Yes, sir, it is visible.
Okay. Thank you. Thank you.
Yeah.
So today's topic is applicability of provisions of TDS on payments that we make to the non-resident. And I've divided this discussion into 4 buckets. First, I will discuss about the provision of section 195, where we will take you through the overview, scope, applicability, what are the payments covered, who is required to deduct TDS, and which kind of payments are covered under section 195. Secondly, I briefly touched upon the MLI provisions and its impact on the TDS provisions, impact on the DTAAs which the India has entered into various countries. Thereafter, we'll discuss the documentation and the procedural aspect. And thereafter, case studies related to section 195, 115 CA, 15 CB. And we can have a question and answer round if time permits. Objective of withholding tax on payments that we make to non-residents. We all know that TDS is to be deducted because government needs revenue upfront. But when it comes to non-resident, it is just not collecting revenue upfront. It is also to ensure that the income which the non-resident is collecting or earning in India or receiving in India, he pays his share of taxes in India. Because in a situation where I fail to deduct TDS on the payments that I'm making to a non-resident, and if that non-resident is not having any presence in India, he does not have any asset in India, then the government is at loss of revenue of tax. And therefore, to ensure that the taxes are collected upfront, rightfully, and that the non-resident does not run away from paying taxes, the government has put an onus on the residents as well as non-residents who are paying income to a non-resident, which is chargeable under the Act, to deduct TDS. And to ensure that this is religiously followed, what the government has done is that it has made it more onerous for the payer to deduct TDS, because failure to deduct TDS would lead to disallowance of expenditure, payment of interest for the losses that the government is going to suffer, compensate them for the losses, penalty, and even in certain situations, prosecution. And therefore, non-deducting TDS, not testing the payments for TDS, comes at a peril, which we may not take a chance with, and therefore the provisions of TDS, though may appear to be procedural, but are more rigorous and are to be therefore followed more rigorously. What are the payments or what are the sections which are applicable when I make a payment to a non-resident? I've listed some of the section and the rates which are applicable in relation to such payments. If you look at in front of your screen, there are sections like 194 LC, 194 LD, which cover TDS on interest, interest on ECBs, interest on specific bonds or securities, where the section itself gives a rate of 5%. But when I look at section 192, which covers payment of salary to a non-resident employee, the TDS is to be deducted as per rates in force. Again, if I look at section 194E, the rate TDS is to be deducted as per the rate which is specified in said section. But when I come to section 195, which is a overarching provision covering all other payments which are not covered otherwise in other sections, the TDS is to be deducted as per the rates in force. And if I look at section 195, it covers all streams of income, right from interest other than the interest which is specifically covered under 194 LCLD, commission, business receipts, royalty, FTS, commission, etc. All these are different streams of income, and it is not possible to specify one single rate for all these items of income. And therefore, instead of mentioning one particular rate, section 195 takes you to rates in force, which is a term defined under the Act under section 2, clause 37A, which we will see at the later part of the presentation. So the important point that I wanted to highlight here was that you have to refer to rates in force when you are dealing with section 195. But when you are dealing with specific provisions, you will have to look at respective section and whether there are any rates specified in that section or not. If yes, then you have to deduct as per those specific section. And there is a controversy with regard to whether you can take recourse to double tax avoidance agreement where the section does not give reference to rates in force, which I'll discuss in the later part of the presentation. Because 195 is the most common referred to section. All the various streams of income such as royalty and FTS and other business profits get covered under 195. Our major discussion today will surround on the provisions of section 195. 195 has been divided into 7 subsections. Section 195 subsection 1 deals with the scopes and conditions of conditions for applicability of subsection of 195, where it lays down what kind of payments are subject to TDS, payments to whom are subject to TDS, who should be the payer, whether there is a need for the income being chargeable to tax or not. And if you fulfill all those conditions, then there are the procedural sections of section 195 subsection 2 right up to 195 subsection 7. So once you determine that TDS is to be deducted under 195(1), the requirement is to deduct TDS. But in a situation where the payer feels that the TDS is not deductible or the TDS is to be deducted at a lower rate. Example, when you are making a payment for purchase of an immovable property and you make payment to a non-resident, whether the entire sale consideration should be subject to tax withholding or only the capital gain amount is subject to tax withholding. In such a situation, if there is any ambiguity for the payer on what amount that he should be deducting TDS, then in that situation, he can make an application to the assessing officer for determining the amount of income on which the tax needs to be withheld. So this would generally apply in a situation where the onus of deducting TDS is on the payer as well as he is required to bear the TDS. In such situation, the payer will approach the assessing officer. However, in a situation where the payer is not responsible for bearing the TDS and it is the TDS is to be borne by the payee, the non-resident party, and the payer says that he will deduct TDS on the entire sum or even on the amount which is not chargeable to TDS. In that situation, the payee also has an option of approaching the assessing officer. And section 195 subsection 3 gives that right to the non-resident of approaching the assessing officer. Now, who can approach the assessing officer under 195.3? Not all and every non-residents are covered under 195.3. Only those non-resident who carry on business in India, who through a branch in India. Then in those situations, for all the income that the branch earn other than interest and dividend income, they can make an application to the assessing officer. Further, it does not stop there. There are further conditions. The conditions are like that the non-resident should be regularly assessed in India. He should regularly file returns of income in India for all the years where he was required to file. There is no default in payment of self-assessment tax. He has been doing business in India for at least 5 years. And lastly, his asset base in India is minimum 50 lakhs. So if you look at all these conditions, these are not simple conditions. And it is quite likely that there would be various non-residents which you would be dealing with might not satisfy all these conditions. And therefore, those non-residents who are not able to satisfy this condition, they will not be able to take recourse to 195.3 and therefore no application can be made by them under 195.3. Because of this stricter narrower reading of section 195.3, the conditionality of 195.3, it makes 195.3 a less preferred route. And therefore, we have a residually section 197, which is very commonly used by even residents where they approach the assessing officer to obtain a lower deduction certificate. And therefore, where 195.3 route is not available, the non-resident can explore a 197 route and obtain a lower TDS certificate. 195.4 deals with the validity of the certificate with the assessing officer issues. Generally, the certificates are valid for the period mentioned in the certificate unless the assessing officer revokes them earlier. 195 is a procedural provision allowing CBDT to make rules and procedure for making an application under 195.3. 195 subsection 6 is an important section, and it is through this section that the requirement to file Form 15CA by the taxpayer, the deductor, and filing Form 15CB by the accountant comes in. And section 195 subsection 6 says that you have to file Form 15CA and or 15CB irrespective of the fact whether the income is chargeable to tax in India or not. So despite you taking a call that income is not chargeable to tax in India under 195.1 and therefore you don't deduct TDS, but 195.6 will still trigger in the moment you make a payment to a non-resident, and therefore you will have to file Form 15CA as well as Form 15CB in certain situations despite you don't deduct TDS on the payment made. Lastly, 195.7 is again a procedural section allowing CBDT to make rules. 195A is the section dealing with grossing up of tax, which applies in a situation where the TDS is to be borne by the payer, and it provides the mechanism as to how the TDS to be worked out. I've covered a separate slide on this and we will discuss it separately. What I've also covered is the corresponding provisions under the new Income Tax Act. As the government had said, they have simplified the new Income Tax Act. Therefore, even the provisions related to TDS, which run across section 192 right up to 196, 195, 197, they have been summarized into one single section, namely section 393. Section 393 subsection 1 contains a table providing for rate of TDS on various streams of income which are payable to a resident, whereas section 393 subsection 2 covers the rates of TDS on the payments that you make to non-resident. So like we have 194 LC, LD, 195, 194E, which are applicable in respect of non-resident. Those all have been captured into one single subsection, section 393, subsection 2 of the New Income Tax Act 2025. All the procedural provisions which are contained right now under section 195 subsection 2 right up to 195 subsection 7 have been grouped under the section 395. Apart from this grouping related changes and the form administrative related changes to make it more accessible, more single point of contact for referring to the TDS provision, there is no other drastic changes or fundamental changes. This is in line with what the government had said, that they don't want to bring in any fundamental change to the law which is already in place. So right now, as the Income Tax Bill Act 2025 stands, there are no new changes or no hiccups, no surprises insofar as provision of section 195 are concerned. Going forward, what I've done is divided section 195 subsection 1 into multiple buckets. You can see there are 5 buckets in which I've divided. And this is the most important provision insofar as payment to non-resident is concerned. When does 195.1 trigger and what are its elements? 195.1 triggers when you are making a payment to a non-resident. The payee should be a non-resident, or it should be a foreign company. Meaning, a foreign company is covered under 195 irrespective of it being a resident or a non-resident. Apart from a foreign company, all other payee should be non-resident. Who should be the payer? So whenever a resident is making the payment to the non-resident or a foreign company, he is required to deduct TDS, as well as a non-resident payer is required to deduct TDS under 195. So if you look at the provisions which I have captured above in the first part of the slide, it says any person responsible for paying to a non-resident. It does not say any person being a resident. And therefore, person is wide enough to cover both resident as well as non-resident. On this particular issue, there was a controversy as to how the provisions of Income Tax Act can widen up and apply to a non-resident sitting in some another jurisdiction other than India. How can a non-resident comply with the responsibility of deducting TDS when it is making payment to another non-resident? Isn't it extraterritorial? Isn't it beyond jurisdiction? In the case of Vodafone, the famous case where Vodafone had acquired shares of Hutch from Hutchison, there was a dissenting member who took a view that any person has to be read in a more narrower manner, and it should only cover person being a resident. And therefore, any non-resident making a payment to another non-resident, in that case, Vodafone making payment to Hutchison was not obligated to deduct TDS. This was the view of the dissenting member. To avoid any further complications or any other divergent views on this particular aspect, what the government immediately did was that they introduced explanation 2, which with retrospective effect, clarifying that even a non-resident making payment to another non-resident is required to deduct TDS if the income is chargeable to tax in India. And the non-resident is required to deduct TDS irrespective of the fact whether the non-resident has any presence in India, whether he has a business connection in India. Therefore, every payer, whether resident or a non-resident, is required to deduct TDS. Which are the amounts on which TDS is to be deducted? So it is interest other than interest referred under section 194 LB, 194 LC, 194 LD. and any other sum which are chargeable to tax other than salaries are covered under 195. When is TDS to be deducted? Like all other section, it is to be deducted at the time of payment or credit, whichever is earlier. And as we discussed earlier, the TDS is to be deducted as per rates in force. Who are covered? Any person responsible for paying is covered. Even an individual is required to deduct TDS when it makes payment to a non-resident. Unlike in other TDS provision where the TDS obligation or requirement to deduct TDS for an individual kicks in only if that individual is subject to tax audit, in section 195 we do not have such threshold, and therefore even on a single rupee which and even an individual is making a payment of, even though he is not subject to tax audit, he is required to deduct TDS. Even in a situation of indirect transfers where two foreign companies are exchanging shares of a foreign asset, but the foreign asset is deriving its value from an Indian asset, and that indirect transfer is chargeable to tax in India. Even in that situation, the non-resident payer will be required to deduct TDS on the payment which are made to the non-resident payee. Now, a question comes, what happens to the payment that I'm making to a foreign company whose POEM is in India? Because of POEM, the foreign company is deemed to be regarded as having a residence in India. And therefore, when a foreign company is regarded to have a residence in India, meaning it is a resident in India, whether section 195 apply or not. Now, because the way 195 has been worded, it says any person responsible for paying to a non-resident not being a company or responsible for paying to a foreign company. So when it comes to a foreign company, I don't need to look at his residential status. I only need to understand whether it's an Indian company or a foreign company. If it is a foreign company, then irrespective of whether it is a resident in India or not a resident in India, I will have to deduct TDS as per the provision of section 195. Now, look at a situation if there is a provision which is already covering a payment of a particular sum to a foreign company, meaning there is section 195 which applies, which provides for TDS deduction on payment to a foreign company, as well as there is another section covering specific streams of income paid to a foreign company. Then in that situation, that specific section will prevail over the general provision of section 195. Further, if there is a provision which says that I am paying royalty to a foreign company being a resident in India, whether 194J will have an application or 195, because of the specific language of section 195 which specifically covers foreign company. So despite royalties paid to a foreign company which is a resident, I will not deduct TDS as per 194J. Rather, I will deduct TDS as per section 195, and this has been clarified by CBDT as well by notification number 29 of 2018. One of the important thing that one needs to note is that section, the TDS that you deduct under 195 is not the end of the story. It is only an interim assessment. And therefore, it is always open for an assessing officer to assess the income of the non-resident. And if he feels that the non-resident has been assessed to tax at a lower rate, or the tax which has been collected and deposited is lower than the tax liability that the assessing officer has determined, the assessing officer can raise a demand on the non-resident. In a situation where the non-resident is not traceable or not responding, the law contains provisions under section 163 which can deem the payer as a representative assessee of the non-resident, in which situation the assessing officer can proceed for recovery of taxes from the payer. And therefore, it is very important to ensure that the TDS is rightfully deducted on the right amount and the correct amount of TDS is deducted and paid. Another important point is that unlike other sections of 194C, 194J, where we have a threshold that up to 30,000 of payment no TDS is to be deducted, under 195 there is no such threshold, and even on a single rupee that you make a payment of, TDS is to be deducted. What if I'm making a payment to the branch of a non-resident? Branch or a PE in India of a non-resident, I still have to deduct TDS under 195 because branch do not have a separate legal status. They do not have a separate residential status. If a no, if the parent entity or the company is if a company is a non-resident, the branch will also be a non-resident, and therefore any payment made to a branch will also be tested under 195. Similarly, if I'm making payment to a branch of an Indian company, even in that situation, because Indian company is resident in India, though the payment is made to a foreign foreign branch of the Indian entity, provisions as applicable to the resident payee will apply, and 195 will have no application. Now, when do you check the non-residential status? At the time of payment, you have to see the non-residential status. At some point in time, it may not be possible to determine whether the payee is a non-resident in India for the year under consideration or not, in which situation you may rely upon his past history and also take a declaration from the payee that his current residential status or the residential status in the current year will continue to be a non-resident. We have discussed this, what is covered, interest, as well as all other sum chargeable to tax. Salaries are not covered. There is no threshold limit. How is TDS to be deducted? TDS is to be deducted as per rates in force. However, in a situation where the EO has given nil TDS certificate or a withholding certificate at a lower rate, then TDS will have to be deducted as per those rates as specified by the assessing officer in the certificate or the order. 195 uses the terminology any sum chargeable to tax as compared to other section which specifically refer to any income by way of, and thus the scope of section 195 is very wide, covering each and every sum of income unless specifically covered under any specific provisions of the act. Now, when you are dealing with section 195, any payment which is subject to TDS under 195, it is important to first satisfy the trigger whether the payment is made to a non-resident or not, and therefore you will have to determine the residential status of the payer or the payee. Generally, it is not practically not possible for us to determine the residential status of the payee, and therefore you should take a declaration from the payee covering various aspects, including his residential status. Thereafter, you have to determine whether the income is chargeable to tax under the act or not, whether it has accrued in India, whether it is received in India, whether it is deemed to accrue or arising in India or deemed to be received in India. Once you satisfy that it is chargeable to tax in India, then you proceed with the characterization of the income. What is the nature of the income? Whether it is royalty, whether it is business profits, whether it is FTS, or etc. And this has to be seen from the payee's point of view because the tax is on the income of the payee. The characterization is also from the point of view of payee. If double tax avoidance agreements is available and the payee wants to take recourse to that, then you need to evaluate the provision of DTAA relevant article. And if the provisions of DTAA are beneficial, then you need to take relevant documents from the non-resident which allow him to access the treaty. I have discussed what are the documents that you should be taking from the non-resident. Now, when we say TDS is to be deducted on any sum chargeable to tax, that means that if any amount which you are making payment of is not chargeable to tax in India, or it does not bear a character of income, then on that payment, TDS is not required to be deducted. And this word then, and we have to give importance to these words because if you read section 195 subsection 6, it clearly uses the language irrespective of whether sum is chargeable to tax in India or not, you need to file form 15CA and 15CB. Similar language is not there in 195.1, meaning that if the sum is not chargeable to tax in India, then TDS is not required to be deducted. Question comes when I'm making the payment of a gross amount and only a part income is is chargeable to tax in India, then whether TDS is to be deducted on the entire amount or part of the amount. The Supreme Court in Transmission Corporation had held that if in such a situation where gross amount is paid and in only a part amount is comprises of the income element, then the TDS has to be deducted on the gross amount unless an application has been made under section 195 subsection 2. When the AO provides provides the rates or lower rate or a lower amount on which the TDS is to be deducted. Subsequently, because of the ruling of Transmission Corporation, the Karnataka High Court had an occasion to examine whether 195.2 is mandatory or not. And the court said that because Transmission Corporation requires the assessing officer to make the assessee to make an application under 195 to the assessing officer for determining the amount on which TDS is to be deducted or not. Therefore, irrespective of whether the amount is chargeable to tax in India or not, even if I determine that amount is not chargeable to tax in India, if the assessee is certain pursuant to the provisions of DTAA or pursuant to the provisions of the Indian Income Tax Act, it is held that the income is not chargeable to tax as it is not accruing in India, I still have to make an application under 195.2 for each and every payment. So this is what was held by Karnataka High Court in Samsung Electronics case. Because of this finding and ruling of Karnataka High Court, there was a lot of hue and cry because this would require for the assessees, the payers, to approach the assessing officer for every payment that they are going to make to a non-resident where they feel that pursuant to the provision of DTAA or otherwise, there is no need to deduct TDS. And to overcome this interpretation of of Karnataka High Court, the Supreme Court in the case of GE India Technology said that if the amount is not chargeable to tax and there is no doubt about it, then the assessee need not deduct TDS and that application under 195.2 is not mandatory. And this was a very welcome provision, very welcome interpretation and order which was pronounced by the Supreme Court laying to rest the controversy which was raked up by the Karnataka High Court in the case of Samsung Electronics. So if I have to summarize, if the entire payment is not chargeable to tax, no need to deduct TDS as per the ruling of GE India Supreme Court. If the entire payment amount is chargeable to tax, tax has to be deducted as per the provisions of the Act or the DTAA, whichever is beneficial. If part of the amount is chargeable to tax, then the assessee can deduct TDS on the part of the amount if he is certain about it, either by relying upon the certificate of the chartered accountant under Form 15CB, or where he has doubt about the amount on which TDS is to be deducted or rate of TDS, then he can also approach the assessing officer pursuant to Section 195(2). Just wanted to highlight that when you are dealing with shipping companies, there is a separate section under the Act, Section 172, which will prevail over 195. Question comes that when we say that TDS is to be deducted on only in a situation where amount is chargeable to tax under the Act or not. The way income Section 195 is worded, if you look at it, it says any person responsible for paying to a non-resident, not being a company or to a foreign company. Now read any interest or any other sum chargeable under the provision of this Act. If you look at any other sum chargeable under the provision of this Act, it reads as a single statement, meaning that there is no comma after the word sum, which gives an indication that whether I need to read any other sum chargeable under the provision of this Act as a single reference, meaning interest is one limb of 195 or any other sum chargeable under the Act. And therefore, the chargeability test has to be satisfied qua other payments other than interest. And if I'm making that interpretation, does it mean that when I'm making payment of interest, irrespective of whether the same is chargeable to tax under the Act or not, whether I need to deduct TDS or not? And if I go back to Section 9, which provides for deemed accrual under India, it says that interest will not be deemed to be accrued or arising in India if the funds have been used for the purpose of business outside India or for earning any source of income from a source outside India. So, pursuant to Section 9, there could be a situation where interest is paid by an Indian entity or by a payer to a non-resident for a business outside India, in which case it will not be an income of the non-resident under the provisions of the Act and not chargeable to tax. And therefore, though it is not chargeable to tax, whether by the interpretation which I just made, Will the resident be required to deduct TDS on the interest despite it not being chargeable to tax? The answer is no. Section 195 is, after all, a procedural provision. The requirement to deduct TDS comes from Section 4, subsection 2, which says that if amount is chargeable to tax, then TDS has to be recovered as per the provisions of this Act. So the charging provisions are contained in Section 4. And if it is only once the charge is satisfied that you come to Section 195, and therefore a procedural section cannot override the charging section, and there will be no need to deduct TDS on the interest payment, and the chargeability tax test has to be also attached to interest. And this was also held by Bombay High Court in the case of Cooper Engineering 68 ITR 457, where it said that if interest is not chargeable to tax under the Act, then there is no need to deduct TDS under 195. Section 190, now this is another controversy which had arose because of the ruling of Supreme Court in the case of Pilcom. In that case, the Supreme Court was seized with the issue of 194E. Certain payments were made by an Indian entity to entities based out of Sri Lanka and Pakistan. By relying on the provisions of DTAA, the payer had taken a view that amount is not chargeable to tax in India. Court said that the payments in that situation were not covered by Section 195, but rather were covered by Section 194E. And in Section 194E, unlike 195, TDS is to be deducted as per specified rate. So 194E gives the blanket rate at which the tax is to be withheld. And because there was no reference available to rates in force, and it is rates in force which takes you to double tax avoidance agreement, the payer was not in a position to take recourse to DTAA. And once you are not in a position to take recourse to DTAA, the court said that for 194E, DTAA provision will not trigger, and therefore applying the similar analogy when I'm making payment of interest under 194 LC or LD, where again the TDS is to be deducted as per the specified rate. The TDS has to be deducted as per specified rate without going to DTAA provisions. And therefore, court said that the payer will deduct TDS as per the rates given, irrespective of the fact whether the sum is chargeable to tax under as per the DTA provisions or not. And once the tax is deducted, the non-resident is free to take recourse to the provisions of DTAA and make a claim of refund before the assessing officer. So the point that we take home is that when the payments are covered under section other than section 195, and there is a specific section, specific rate given for tax withholding without there being a reference to rates in force, then despite the income not chargeable to tax by virtue of DTAA, you will have to proceed with tax withholding as per the specific section which is applicable in your case. These are specific sections which I have list down and which deal with royalty. What are the provisions under the Indian Income Tax Act and DTAA? Now, what is the rate at which I need to deduct TDS? So Tate, as we saw that TDS has to be deducted as per the rates in force. Now rates in force has been defined under 237A to mean rates specified in the Finance Act Part 2 or the rates specified under the DTAA as applicable to the respective or the concerned non-resident. Section 90 subsection 2 says that if the provisions of DTAA are more favorable to the assessee, then the payee can take recourse to the DTAA provisions. What is the exchange rate that you need to apply? Because you are dealing with non-resident, there is a likelihood that you would be making payment in a foreign exchange. Now you need to convert this foreign exchange into Indian rupee for the purpose of tax withholding. And as per Rule 26, the dollars need to be converted, the foreign currency needs to be converted into INR by taking the SBI TT buying rate. So now when I'm deducting TDS either on the credit or payment, whichever is earlier. So on the date of credit, I will look at the SBI TT buying rate, convert the foreign currency into Indian currency and apply the TDS rate on the amount which is derived. Now say when I'm ultimately making the payment, there is a change in the rate of exchange. So when I deducted TDS, the dollar was 80 and today the dollar is 82. You would not again deduct TDS on the differential 2 component. The TDS which is deducted and deposited with the government but by taking the exchange rate of 80 is final rate. And there is no need to again recalculate the TDS on the differential component. Whether surcharge or education cess needs to be applied on the rates which are determined under the DTAA. There is no need to deduct TDS on, there is no need to further increase the rates which are given in the DTAA, because DTAA covers not only taxes but also surcharge as well as education cess. And if you have, and for this purpose, if we can look at India Mauritius DTAA, which is in front of your screen, it says that existing the DTAA would cover following taxes. In case of India, it covers Indian income tax, including any surcharge. Now, when cess was introduced, the Finance Act, the Finance Ministry had said that cess is nothing but additional surcharge. Therefore, both income tax, surcharge, and cess are covered within the provisions of DTAA. And therefore, when the DTAA gives up a particular rate of say 10%, 5%, 15%, that is encompassing including the surcharge and cess, and there is no need to further increase that rate with surcharge and cess rates. And also, if you look at the second clause of Article 2, it says the convention shall also apply to any identical or substantial similar taxes. Therefore, clearly saying that you don't need to increase the TDS rates given under DTAA with surcharge and cess. Grossing up under 195A is applicable when the payer undertakes the liability to deduct taxes and bear it. 197 application can be made by a payee, but one of the important criteria for this is that the payee should have a PAN. If payee is not having permanent account number, then he cannot make an application under 197. Any application made without that, the assessing officer will not be processing such request. Now, what is the significance of obtaining PAN apart from the fact that I need it for 197? We have section 206AA, which says that if I'm making a payment, if I'm deducting any taxes to and the payee does not have a PAN, then the TDS has to be deducted as per the rates specified under the Act or rates in force or at the rate of 20%, whichever is higher. So therefore, if I don't have a PAN and I don't and my tax is to be deducted as per the provisions of the Indian Income Tax Act, there is a situation where the payer will have to deduct TDS at the rate of 20%. So even in a situation where the TDS otherwise were deductible at 5%, say in case of 194 LC, but in absence of PAN, there is a risk of TDS being deducted at the rate of 20%. However, if I'm making payment to a non-resident of specific streams of income like interest, royalty, FTS, capital gains, dividend, and the non-resident has not obtained PAN, but he provides me details such as his name, email ID, contact number. He provides me tax residency certificate of a foreign country of which he is a resident. He gives me tax identification number of that country. Then, despite me not having a PAN, Rule 37 BC provides an exemption from applicability of Section 206AA, and in that situation, even though I don't have a PAN, the TDS will not be deducted at the rate of 20%, but as per the rate given in the specific section. Whether surcharge or education cess will be applicable when I applied the tax rate of 20% under Section 206AA. Again, the rate under 206AA of 20% is a flat rate. There is no need to increase it with the rate of surcharge and education cess. This was clarified by CBDT in Circular number 17 of 2014, which they had issued in the context of provisions of salary, and where they said that TDS is deductible as per 206AA, it should not be increased with amount of cess. Though this was issued in the context of Section 192, but it should provide persuasive value for 195 as well. Further, the Delhi IIT's Computer Science Corporation has held that no TDS will, when you deduct TDS as per 20%, 206AA, you don't need to increase the rate with surcharge and cess. Now comes the interesting situation where I don't have a PAN, and therefore 206AA requires me to deduct TDS at the rate of 20%. But because of DTAA, the amount is not chargeable to tax in India. Whether in such a situation can 206AA override the provision of 2 DTAA or not? 206AA start with the non-obstante clause, which said that notwithstanding anything contained in any other provision of the Act. Therefore, as per one view, it also overrides Section 90, which in a way give you which in a way provides that in a situation where DTAA is favorable, the assessee can take recourse to DTAA. So even the provisions of 90 are overridden, and once the provision of Section 90 are overridden, once DTAA recourse is taken away, then in that situation, though the amount is not chargeable to tax as per DTAA, though the amount is chargeable to tax at a lower rate as per DTAA, as per this particular view, 206AA should override and the TDS has to be deducted at the rate of 20%. However, a better view seems to be the later view, because 206AA is a procedural section. It only kicks in if the amount is chargeable to tax under the Act or not. So when an amount is not chargeable to tax under the Act, or pursuant to Section 90 subsection 2 read with DTAA, if the amount is not chargeable as per the provision of DTAA, if the chargeability fails, then the machinery provision of 206AA have no application, and therefore a better view is that once DTAA recourse is available, the amount is chargeable at lower rate or not chargeable to tax as per DTAA, you will not deduct TDS at the rate of 20% under 206AA, despite you not having the PAN. And this has been confirmed judicially by the Pune Tribunal in the case of Serum Institute of India. This is an interesting interpretation which I'm going to throw up with regard to grossing up. What Section 195A says, where the payer is going to bear the TDS, then in that situation, he needs to do a reverse working. He needs to increase the amount of income in such a manner that after deduction of tax, the amount would come to the amount that I'm going to make payment to the non-resident. So in a situation where I'm making payment to a non-resident of 100 and the TDS rate is 10%, then you will gross it up by saying that the 100 that I'm paying to non-resident is only 90% and the 100% would be 111. Now in a situation where the non-resident does not have a PAN and is not taking recourse to DTAA, the TDS rate would be 20%. Question comes whether I need to gross up at the rate of 20% as per which is the rate given under 206AA, or at the rate of 10%, which may be applicable in his case as per the relevant provisions of the Income Tax Act, or say 5% if it falls under 194 LC. It is possible to take a view that you will gross up not at the rate of 20%, but at the rate of 10% or 5% as the case may be. And the reason for saying that is, if you read 195A, it says that where under an agreement, the tax chargeable on any income referred to in the foregoing provisions of this chapter is to be borne by person by whom the income is payable, then for the purposes of deduction of tax under the provision, such income shall be increased to such amount as would after deduction of tax thereon at the rates in force. Now, rates in force does not include reference to 206AA. Rates in force gives reference to Part 2 of the Finance Act, which does not again include 206AA. And therefore, if as per the rates in force TDS is to be deducted, the applicable tax rate is 10%, then you will gross up at the rate of 10%. And therefore, because of which the amount of income would be say when I'm making a payment of 100, that is 90%, by 10% the income would come to 111. On then 111 I will deduct TDS at the rate of 20%, where the TDS would come to 22.22 as against the rate TDS of 25, which would have come if I would have done the grossing up at 20%. Thereby we are saving roughly 11% of the taxes. So this makes though 11%, but where the payments are of a huge value, this could turn up to be a huge saving for the payer if he's bearing the taxes. This view has been confirmed by the Bangalore Tribunal in the case of Boss Limited. Significant economic presence. This is a provision which was recently introduced by Finance Act 2018 in Section 9(1) to say that if a non-resident has a SEP in India, where it has given the threshold of 2 crores and 3 lakhs user, then it is deemed to be having a business connection in India. So therefore, whenever you are making a payment to a non-resident, you apart from royalty and FTS, you need to also evaluate whether the non-resident is having a SEP in India or not. And therefore, considering that it may not be practically possible for us to evaluate whether he has a SCP in India, therefore you should be taking a declaration to this effect as well from the non-resident payee, specifically declaring that he does not have a SCP in India. In a situation, if he says that he has a SCP in India, then the implication could be in a situation where India has a access has a DTAA with that country and the non-resident is taking the access to DTAA, because there is no similar provision of SCP in DTAA. So therefore, even though pursuant to the Act, there is a business connection on account of SCP, but because of DTAA, there will be no permanent establishment in India, and therefore such payment may not be subject to TDS if it is not falling under other articles. In a situation where India does not have a DTAA with the foreign country, or in a situation where the non-resident is not able to take recourse to DTAA, then in that situation, because it will be deemed to be having business connection in India, the non-resident will be deemed to be having business connection in India because of SCP, you will have to deduct TDS at the rate prescribed under the Act, which, and if it is a business profits, then you might have to deduct TDS at a higher rates. Now we'll deal with the provisions of MLI. MLI was an instrument which was released by the OECD pursuant to the BEPS action plan. There were various action plans which were introduced. We will not get into all those. We'll limit our discussion to two action plans, Action Plan 6 and Action Plan 7. 7 dealt with artificial avoidance of PE. We have seen in past that when most of the non-resident take recourse to DTAA, and because of the specific language of DTAA, the amount is not chargeable to tax in India. To fit their case into DTAA, people find out the loopholes, and particularly in a situation where I'm making a payment of business profits, the non-resident would identify the manner in which they can avoid a PE. They might enter. So in a situation where a non-resident is doing a business in India, he may not directly come and do a business in India. He might appoint a commission agent. Everything would be done by the commission agent on and for behalf of the non-resident. The contracts will be entered into by the agent in its own name. He will sign the contracts. He will collect the money, but this all would be done at the behest of and under the instruction of the non-resident. So it is the non-resident which was running the show. It was controlling the affairs of the commission agent. But for us, and through this, the PE was avoided in India, and therefore it was, and consequently no TDS was deducted because it was held that I don't have a PE in India. To overcome this kind of situation, we have now provisions of DTAA which have been modified through MLI. Article 12 specifically says that if the agent is acting on behalf of the non-resident, then it will be deemed to be a PE of the non-resident. Similarly, we have seen that where it was a contract, a construction PE, which required that the non-resident should have at least 120 days or 180 days presence in India. The non-resident would generally split up the contracts amongst their group entities, where for a particular period, the group entity, a company of the group would provide the service, and for the later half, the B group entity will provide the services to the Indian resident. Now again, through MLI, this has been plugged, and the MLI provisions provide that in such a situation where the services are provided for a connected contract and by the related parties, then the period of holding or the period in India has to be aggregated, and a consolidated period has to be seen for determining the P in India. Similarly, Action Plan 6 has been introduced to prevent treaty abuse, wherein they have said that if the principal purpose of accessing a particular treaty was to save tax, then the non-resident will not be entitled to take recourse to the treaty provisions. So therefore, whenever I'm testing 195 and pursuant to the provisions of DTAA, I come to a conclusion that the TDS is not deductible, then I need to ensure that there is no abuse of the DTAA provision which is undertaken by the non-resident, and therefore, wherever possible, you should take steps to identify whether there is any such element of avoidance, there is such element of abuse or not, and if it is not possible, again, a suitable declaration should be taken from the assessee, from the non-resident, where he would declare that the principal purpose is not to obtain tax benefit. Okay, how will you read MLI? You will have to see whether the countries have notified MLI, whether India as well as the other contracting state have notified their treaties to be a CTA, whether both have adopted the same action plan of the MLI, same article of the MLI, and if yes, then the DTAA will have to be read together with the MLI provisions. For ease of reference, the OECD has provided a synthesized text which sits along with the current DTAA provisions, capturing also the relevant MLI provision which have been adopted by the respective countries. So if you go on to the income tax website, you get the option to review the comprehensive tax agreement as well as the synthesized text, which captures the MLI provisions together with the DTAA provisions. Again, now when you look at synthesized text, one thing that you need to be mindful of that the synthesized text is not a binding document. It is just an explanatory document which has been collated together for ease of reference. So there could be a situation where the synthesized text may suggest something else contrary to the provisions of the normal DTAA. And to highlight this situation, there is a classical case of India Belgium DTAA. If you refer Article 12, which is dealing with royalty, as per the DTAA, normal DTAA, the tax rate is 10% on the royalty payments. But if you refer synthesized text, the tax rate mentioned in the synthesized text document is 20%. In such a situation where there is a dichotomy between the DTAA and the synthesized tax, you will have to go strictly as per the DTAA provision because those are notified by both the countries. Synthesized tax is just an explanatory statement. It is not binding on revenue nor on the assessee. And this was also held by the Mumbai Tribunal recently in the case of Sky High. This is a controversy which is emanating recently because of the ruling of Mumbai Tribunal in the case of Sky High. The issue was whether the payer needs to evaluate the provisions of MLI while making payment to the non-resident. One view is that impact of MLI need not be considered by the payer, and the reason for that is MLI provisions are subjective provision. It is not possible for the payer to evaluate and determine whether the principal purpose of the non-resident was to obtain tax benefit, and therefore where it is not possible for me, I can't sit into the chair of an assessing officer and undertake an assessment of the non-resident. Secondly, MLI is a document released by OECD. After adoption of the respective articles of MLI, the treaties have not been again notified by India or by the other contracting state, and therefore Sky High, in the case of Sky High, Mumbai Tribunal said that unless and until the provisions of MLI qua particular treaty have not been notified, then that treaty has no effect, and therefore the assessee is not bound to apply the provisions of MLI. The assessee should only apply those provisions which have been notified by DTAA or by the respective governments. And therefore, despite there being a situation where there could be a possibility of the non-resident taking recourse to DTAA with the principal purpose of obtaining tax benefit. But because the treaty has not been notified, the treaty with MLI has not been notified by the government of India, I will not read into the MLI and I will not deduct TDS despite PPT test not getting satisfied. Though little aggressive and need not be always taken recourse to, particularly in a situation where TDS is to be borne by the payee. I would not want to go through this route and take heads on to the tax department and then get into a litigation with the tax department. I would want to have a peace of mind and move on. However, in a situation where I fail to deduct TDS for some reason, I might take recourse to this thing. Or in a situation where the stakes are very high and the TDS is to be borne by the payer, he may think of exploring these provisions. Though it is a Mumbai ITAT ruling, but while giving this ruling, they have relied upon the famous ruling of Supreme Court in the case of Nestle India where they were dealing with the situation of MFN applicability on the dividend payments made to non-resident, and the courts there had said because the MFN or the protocol was not notified, therefore in that situation you can't apply any other provision which are not notified by the government of India. So, though ruling of Mumbai Tribunal, but the principle emanates from the ruling of Supreme Court. Another view, a conservative view, is that MLI has to be considered, and the reason is that when you are taking recourse to DTAA, you are taking a complete recourse to DTAA. You can't look at the DTAA provisions in part. You have to look in a toto. And also the SOM committee, while dealing with GAR provisions, had said that when I'm making payment and I'm required to deduct TDS, I have to do a complete assessment. I have to evaluate whether there is any element of abuse involved or not. The deductor should take fair amount of due diligence to ascertain the correct amount of tax payable. So, particularly coming to a conclusion here that that the payer cannot shy away from the responsibility of at least making an effort to evaluating whether MLI provisions have been complied with by the payee or not. And if it is not possible for the payer to evaluate, he can take a declaration to that effect to satisfy himself and the tax department that he has taken reasonable steps for in proper spirits to ensure that the payee is not abusing the provision of DTAA. This was a situation, one of the situation I wanted to cover was in past we have seen that when I'm making payment of dividend to non-resident, the TDS is deductible at the lower rates as compared to the rates given under the Act. What for one to access take recourse to DTAA, it was very simple. As per the provision of DTAA, in many treaties, the tax was chargeable at the rate of 5%. And for taking recourse to that provision, the non-resident had to satisfy two tests. One, he should be the beneficial owner, and secondly, he should be holding specified percentage of shares in the company. Now, these conditions were required to be tested by the non-resident on the date of dividend payment to such person. And therefore, whenever I used to test the TDS, I would test this provision on a particular date. It was very easier for the non-resident to arrange their affair to just before the receipt of dividend, they would acquire the beneficial ownership as well as they would acquire the relevant percentage in the target entity. And because these conditions were satisfied on a particular date on which the TDS was to be deducted or tested, it was easier for the non-resident to get the dividend money by deducting TDS at the rate of say 5% or 10%, which was quite lower than the rates which would otherwise be applicable. To overcome this situation, what MLI said that the requirement of holding a particular percentage of share is not to be tested only on a particular date. It is rather to be seen over a period of 365 days. So only if I'm holding shares for a particular percentage or stake or worth for a period of 365 days, then only I will be entitled to a concessional rate of rate provided under the DTAA. Further, even if I satisfy this test of 365 days, I again need to satisfy the test of principal purpose test. So though I am satisfying 365 days test, but the principal purpose is only to take tax benefit, then again I can be denied the recourse to DTAA provisions. So we need to be mindful of all these provisions. There have been various treaties which India has decided to adopt these provisions. Uh, the applicability of this article of MLI will depend upon the recipient, the other contracting state also required to adopt such similar article. Once both the countries adopt the articles, then only this will come into force. So whenever you are making a payment of dividend, you need to ensure that the treaty that you are taking recourse to, whether it has a provision similar to the one which is adopted by India. These are the procedural aspect which I'm covering. When you need to deduct TDS, you need to deduct TDS at the time of making payment or credit, whichever is earlier. What should be the date of payment? You need to deduct TDS on and pay the TDS on or before the 7th of the next month. However, for the month of March, the TDS can be deposited till the month date of 30th April. TDS certificate is to be provided within 15 days from the due date of filing the TDS return. 15CA, 15CB has to be filed in particular instances. 15CA has to be filed in all instances. 15CB has to be filed by the CA in a specific situation. What are the critical documents that one needs to obtain while making remittance to a non-resident? If a non-resident is taking recourse to the DTAA provision, he needs to submit the TRC. Again, he needs to file Form 10F. 10F is a mandatory requirement which earlier where a non-resident was required to have a PAN. Now there is no need to have a PAN for filing Form 10F. Take a declaration on various fronts as we discussed, including principal purpose trust, business connection, no SCP in India where the payments are of business profits. Also, wherever possible, take PAN from the non-resident if he is having one. If he is not having the PAN, then take the details such as TRC and other documents which may be which are prescribed under Rule 37 BC. Once you obtain all the document, thereafter you need to proceed with filing of Form 15C and 15CB. This we discuss requirement for filing Form 15CA and 15CB comes from 195(6), which says that it is to be filed furnished irrespective of the fact whether the income is chargeable under the provisions of the Act or not. 37BB gives the list down the situation under which you need to file Form 15CA and in which situation you need to file Form 15CB. So where I'm making a payment to a non-resident of a sum which is of a value less than 5 lakh, then I only need to file a Form 15CA. So even though the amount is chargeable to tax, but if the amount of income is less than 5 lakhs, then the only form that needs to be filed is Form 15CA and you don't need to file Form 15CB. If the amount is more than 5 lakhs, and you have obtained a certificate from the AO either under section 195 or under section 197, then you need to file 15CA part B of form 15CA. If the amount is more than 5 lakhs and you have obtained 15CB from the chartered accountant, then you need to file for part C of form 15CA, as well as the AO, the chartered accountant will have to file form 15CB. In a situation where the amount is not chargeable to tax at all, you need to file Part D of Form 15CA. Additionally, the Rule 37BB, Sub Rule 3, lists down 33 instances, 33 transactions, in which situation you don't need to file either Form 15C or 15CB. 90 subsection 4 made it mandatory for the non-resident to produce the TRCs, without which the recourse to DTAA provision is not allowed. So in a situation where TRC is not available, whether the non-resident can still avail uh, recourse to the DTAA provision. It was in SCAP's industry, the non-resident was not able to produce TRC. However, he produced alternative document which was provided by the government of the country of which the non-resident was a resident. The Ahmedabad tribunal in that case examined that the document which was produced other than the TRC contained all the details which were otherwise available or captured in a TRC. And the court, after examining the document, considering the peculiar facts of the sad case, came to a conclusion that because all the details as are required in a TRC are present in this document, the non-resident would be entitled to the provisions of DTAA. Also, in the later case of Srinivasa Reddy, it was held that whether non-resident takes steps, best possible efforts to obtain TRC, but is not able to obtain the TRC. Say for a situation where I have a TRC in the past year, I have made an application for TRC in the current year, but I have still not received it, and I take all the steps for obtaining the TRC, but still it is not available. Then in that situation, due to impossibility of the performance, the non-resident should not be punished, and 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 therefore, if the non-resident is able to demonstrate, provide you with the proofs of application made, provides you with the proofs of early TRC for earlier years, in that situation, you may still allow him to take recourse to DTAA and deduct TDS as per the beneficial rates of DTAA. However, to safeguard yourself, it is advisable that you also take a declaration or an indemnity to offer indemnity to that effect from the non-resident to protect yourself from any future challenges or litigations from with the tax department. This I've just created a flow chart. So on the left side, I've said that where a situation where the amount is chargeable under the IT Act. If the answer is yes, you have to see whether the pen is available or not. If the pen is available, then section 206 AA do not apply and the TDS will be deducted as per the rates in force. However, if pen is not available, then in that situation, you need to see whether the case is covered by Rule 37 BC. 37 BC, as we saw, applies only in respect of certain payments such as interest, capital gain, dividend, FTS, royalty. It does not apply to business profits, rent, and various other payments which are not specifically covered under Rule 37 BC. So you need to see whether that payment is covered under Rule 37 BC. If it is covered under Rule 37 BC, whether the documents as required under 37 BC are available or not, and what are the documents or that Rule 37 BC requires? It requires the name of the non-resident, address of the non-resident, TRC of the non-resident, and tax identification number of the non-resident. If these four things are available, then 206 AA does not apply, and then the TDS has to be deducted as per the rates in force. However, if the details as per Rule 37 BCs are not available or in a situation where the amount is not covered by Rule 37 BC, then 206 AA will apply and TDS will have to be deducted at the rate of 20% or such other or higher rate as may be applicable in that case. This was insofar as when the payment was covered under the IT Act. When I'm making a payment to a non-resident and I have to test the provisions of IT Act. But if the provisions of DTAA are to be tested, then first I need to see whether the DTAA is entered into with that country or not, whether the non-resident is eligible to take recourse to DTAA, and whether the rate provided under the DTAA is beneficial or not. If it is beneficial, I will see whether he is having TRC and Form 10F. He is not having TRC and 10F, then DTAA is not available and therefore beneficial rate will not be available. In a situation where he has TRC, I will see whether he has a pen or not, or whether his case is covered under Rule 37 BC or not. If his case is not covered by Rule 37 BC, meaning the payment that I'm making to him is not interest, dividend, capital gain, or such other payment as covered as mentioned in 37 BC, then as per one view, I will have to deduct TDS at the rate of 20% under 206 AA. Alternatively, as we discussed earlier, if once I am able to held that TRC is available and DTAA is applicable to the non-resident, then in that situation, as we saw that Serum Institute in the case of in the Pune Tribunal in the case of Serum Institute held that 206 AA will not override treaty, and therefore if I go by with that view, then even though in that situation if PAN is not available and the payment is not covered by Rule 37 BC, I will still be taking recourse to the treaty and I will deduct TDS as per the beneficial rate applicable to the uh, non-resident as per the DTAA. Now, these are the undertakings or the indemnities which we should generally take from the non-resident in a situation where it is practically not possible to evaluate the transaction from MLI perspective, or due to the peculiar characteristics of the transactions or the manner in which the MNCs are operating, or in a situation where the MNCs or the non-resident requires you to not deduct TDS by based on his interpretation of DTAA. In all those situations, it is advisable to take an indemnity if it is not possible for you to deduct TDS. In a declaration, you should cover that he is a eligible person, eligible to take recourse to DTAA. He is a resident of a particular contracting state. He does not have a POEM in India. He does not have a PE in India. The principal purpose of him is not to obtain tax benefit. He is the beneficial owner of the income, and also an indemnity clause to indemnify you in a situation if there is any tax demand on the deductor. Just a second. I've covered some of the case studies. Tax withholding on payments in kind. This is a situation where where the resident is making payment to a non-resident by way of a monetary consideration. You need to deduct TDS under 195. But what if the consideration is discharged in kind? Whether do you need to deduct TDS or not? Because 195 one uses the word sum, any sum chargeable to tax. Can you say that sum means only monetary consideration and therefore consideration in kind need not be covered? In context of section 80G, Supreme Court had said that sum has to be read as a monetary consideration and therefore any donation given in kind was not covered by 80G. However, similar issue came up under section 195 as well. This was a case where the resident had taken ships of non-resident on hire, and through that vessel they did fishing in the international waters. As per the terms of the contract between the resident and the non-resident, the consideration was to be discharged in the form of 85% of the fish that I had caught, and accordingly, the fish that I had caught and brought into India, out of that, 85% of the fish were given to the non-resident. The assessee did not deduct TDS on two counts. First, on the ground that no income arose in India and therefore not chargeable to tax in India. And secondly, the consideration was paid in a form in kind and therefore no TDS is required to be deducted. Supreme Court in the case of Kanchenjunga Seafoods held that because the fishes were brought into India, till the time it was not given, the 85% share was not given to the non-resident, the fish belonged to the residents. The 85% share came, the entire 100% fish came to India first, and thereafter the payment was made to the non-resident. The non-resident received the fish in India, therefore the receipt was in India and therefore chargeable to tax in India. And secondly, they said that discharge of consideration in kind is also covered, and under 195 you need to deduct TDS. Similar view was echoed by Bangalore ITT in the case of Biocon Pharmaceuticals. When a non-resident adjusts the recovery, the amount that he has to recover from you against other dues which he has to pay to you, whether in that situation, so basically in the situation where where the payment is made through a book entry, whether there is a need to deduct TDS, answer is yes. Consideration amount, any amount paid under through any other mode is also covered. So when a payment or a consideration is discharged or any sum is paid, any sum chargeable to tax is paid through a book entry, even that will be subject to TDS. And therefore, if a residence therefore, the resident would be required to deduct TDS, comply with the provision of 195, file form 15CA, file form 15CB, if and also evaluate the need to grossing up in that situation. Another situation is that whether TDS is to be deducted at the time of credit or payment as given under section 195, or do I need to deduct TDS at the time of payment? And this controversy comes particularly considering certain language in the DTAA. For example, in certain DTAA entered into by India, and context of article related to dividend, the language says that on the dividend paid, TDS has to be deducted or the amount chargeable to tax is 10%. The reference is to the word paid. Because of the word paid, can I take an interpretation that I will deduct TDS only at the time when the dividend is paid and not at the time when I'm making the credit of the same in my books of account? Once I'm able to take recourse to DTAA provisions are beneficial to me, then pursuant to 90 subsection 2, I can take complete recourse to DTAA, and it is possible for me to take a view that TDS has to be deducted only at the time of payment as per the language of DTAA. And there are rulings that support this. However, this is very aggressive argument. The counter argument is DTAA is only for the benefit of non-resident. The need to deduct TDS or the timing of deducting TDS is flowing from the provisions of the Act. And for the payer who is a resident, he has no recourse to DTAA. So when it comes to complying with the provisions of 195, he has to deduct TDS as per 195 alone without going into DTAA provisions. And therefore, conservatively, though it is advisable that TDS has to be deducted in accordance with provisions of 195. Another thing that comes to my mind is whether TDS needs to be deducted on the reimbursement amount which you make to the non-resident. It is quite frequently seen that the non-resident claims that the amount that he is paid to him is in the nature of reimbursement, and therefore, because it is in the nature of reimbursement, there is no income element. He is recovering cost to cost, and therefore TDS need not be deducted. Uh, in that situation, you need to evaluate the transaction on the facts of each case. If the amount that you have paid to the to the non-resident has actually no element of income, and it is actually in the sense of reimbursement, then there is no need to deduct TDS. However, in a situation where suppose you had availed of a technical service from a non-resident, however the payment to that non-resident is made by your group company who's based outside India, and the payment is made by the group entities based outside India to the service provider without deducting TDS. Now, subsequently, when the payment is made by the Indian payer to the subsidiary, can the Indian payer claim that no TDS is deductible because the payment to the subsidiary is in the nature of reimbursement? The payment does not constitute income in the hands of the subsidiary, and because it does not constitute income not chargeable to tax, TDS is not required to be deducted. Through this approach, what has happened that the TDS, which was otherwise deductible on the payment which I would have made directly to the non-resident service provider, I am able to overcome by interposing a group entity. This was a specific situation which Mumbai Tribunal had to deal in the case of CU inspection. And they said that if the payment at first place was chargeable to tax in India, then TDS obligation has been imposed upon by the act on the payer. Then in that situation, irrespective of the fact that you have interposed a subsidiary entity or a group entity, you cannot overcome the requirement of tax withholding. In that situation, the amount to be remitted by the overseas group entity to the non-resident service provider should be net of tax, and the tax element has to be therefore deducted and paid to the government of India by the payer. Therefore, you can't overcome a TDS requirement by just interposing group entity and giving the nomenclature of reimbursement. When I'm making payment for a project outside India, whether I need to deduct TDS or not. So in this particular case, ICO is an Indian entity which is incorporated in India and has taken project outside India. The ICO has for this project has availed services of FCO in relation to the aforesaid project, and FCO is entitled to receive the payment. The question is whether I need to deduct TDS on this payment or not. If and in this situation, I need to evaluate whether the payment is made for the purpose of for a purpose of business outside India or for the purpose of earning an income from a source outside India. If I'm able to satisfy this test of accrual outside India, then the income does not accrue in India and not chargeable to tax in India. And if it is not chargeable to tax in India, then no need to deduct TDS. Therefore, for determining the source, you need to evaluate whether the contract was signed in India with the foreign company or not, whether the foreign company has performed any service in India or not, whether the income has been received by the foreign company in India or not. If the answer is that if the contract was executed outside India, income was paid outside India, actual activity were performed outside India, and the entire all the limbs of the business will be performed by the Indian entity outside India, then in that situation, it is a good case to argue that income shall not be deemed to accrue or arise in India, hence not liable to tax under the IT Act. Whether tax is to be withheld on payment that I'm making to a PE of a foreign company. So in a situation, say if FCO is an entity based out of USA, it has a manufacturing facility in India, and that constitutes the PE. An Indian entity is making the payment to the PE of the foreign company. If it is a PE of India, then in that situation, then I will, because PE does not have an independent legal status, I will still deduct TDS as per the provisions of 195. Because it has a PE and this is a business payment or royalty FTS, the TDS will be deducted at the rate of 40% plus surcharge and cess. It is possible to take a view that because the payment has to be the TDS has to be deducted as per the rates in force, and rates in force takes you to the part 2 of the Finance Act. Part 2 of the Finance Act do not bifurcate between payment to a PE or to a person other than a PE. It simply gives the streams of income and it provides the rates of TDS. So therefore, if the rates of TDS against a particular payment are say 20% only, then in that situation, it may be possible to deduct TDS at the lower rate of 20% as against 40% on the net income. Though, however, this interpretation is little litigative, and therefore, on a conservative basis, it is advisable to deduct TDS at a higher rate. However, on a last resort, you may think of deducting TDS at the rate of 20%. We discussed this whether TDS has to be deducted on gross basis or net basis. CBDT itself recognizes that TDS can be deducted on only income element, and therefore TDS can be deducted on a portion of a amount which is attributable to the income element and not on the entire amount. Even there is a corresponding circular in the context of Section 40 AIA where it says that if the TDS was to be deductible and only uh, of the total amount, only part amount was charged had the income element, then the assessee will be deemed to be assessing in default only in respect of the such part amount which was compressed in the entire payment. In a situation where, say, foreign bank is making payment to the non-resident on behalf of the Indian resident, whether then there is a need to deduct TDS or not, because the payment is made on and for behalf of the Indian resident, the Indian resident will still be required to deduct TDS on the amount which have been remitted by the foreign bank to the non-resident. This is a situation where I'm paying interest on outstanding purchase price. Whether I need to deduct TDS on the interest amount or can I claim it to be part of the purchase price? And because I don't have a PE, the purchase price should not be chargeable subject to TDS in India. Arguments in favor are that interest payable on unpaid price is a part of sale consideration only. Such interest is not independent. There is no borrower-lender relationship. I have not taken any loan from you. I have not taken any debt from you, and therefore this is not interest. And because I don't have a PE in India, pursuant to DDAA, I will not be chargeable to tax under the act, and therefore there is no need to deduct TDS. Argument against is that word interest is very wide. 228 has been defined in widest manner. Uh, Interest paid on purchase price is akin to his interest on your obligation. And if you refer section 228, it also covers interest paid in pursuant to an obligation or a debt. And in case of Vijay Shipping Corporation, Gujarat High Court had categorically said even though you don't have a debtor or lender relationship, TDS, the amount will still get characterized as interest, and therefore TDS has to be deducted on those payments. In a situation where amount is not chargeable to tax, say look at a situation where a foreign company has a capital asset in India. He sells that capital asset for the same price at which it had acquired, and consequently there is no amount chargeable to tax in India. In such a situation, whether it is required advisable to file Form 15CA Part C or you need to file Part D of 15CA, as we saw, for Part D applies only in a situation where the amount is not chargeable to tax. So 195 subsection 6 says that irrespective of amount chargeable to tax, you need to file Form 15CA, 15CB. Part C of 15CA is to be filed in a situation where I take a where the amount is more than 5 lakhs and the amount is certified not and it is backed by a certificate of a chartered accountant. Part D applies in a situation where the amount is not chargeable to tax at all. Technically, it is possible to take a view that because it is not chargeable to tax, I will proceed with Part D. However, looking at the amounts involved and also in order to avoid any future litigation on this reporting requirement, it is advisable for the assessees to obtain a certificate from AO, from the chartered accountant in Form 15CB and file the details as part of in Part C of Form 15CA. Also, it is important to note that there is a penalty on the assessees if they furnish to file information or file inaccurate information under Form 15CA. So, as per Section 270I, there can be a penalty of 1 lakh which can be imposed upon the payer. This is just the summary. when making payment to non-resident, check if the payment is covered by Section 195, whether payment is made to it is immaterial whether the payment is made by the resident or non-resident. What is important is whether the payment is made to non-resident or not. Check the nature of income. Check factual and basic documents, invoices, contracts, legal status of the recipient, whether he has a TRC or not, whether he has given no P declaration, whether he has given no poem declaration, PPT test, beneficial ownership test, whether he has a PAN or not. Identify the nature of income, whether it is chargeable to tax or not. And once it is chargeable to tax under the IT Act, then only you need to evaluate whether it is chargeable to tax under DTAA or not. If the amount is not chargeable under IT Act because it is not deemed to be accruing or arising in India, the recourse to DTAA is not required at all. Uh, Check whether there is any lower TDS certificate or not, and then you proceed with the filing of Form 15C and 15CB. This is the golden rule. Whenever in doubt, deduct TDS. Be conservative. Uh, Take aggressive approach only in situation where you have missed out or where the tax incidence is on the payer. Uh, I am done with the session. I think so. We can take now questions if any. Chanchalji, you are on mute.
I am not on mute, sir.
No, okay, I can hear you now.
Yeah, I was just checking the Q&A box. I don't think there are any open questions.
Right.
Yeah, there is one, sir. Kindly elaborate on MFN clause in a treaty and how it needs to be applied.
So this was particularly in case of dividend where um, India had made, so where an Indian company was making payment of dividend to a non-resident shareholder based out of a particular country. And as per the DTAA provisions, say for example, in that India and Portugal, the DTAA provisions provide for a dividend taxability at the rate of 15%. Because now what I will look at is that DTAA provision, whether they have a MFN provisions or not. What are MFN provisions? MFN provisions are the provision which both the countries have agreed upon, saying that if I enter into any favorable terms with another country, if the DTAA entered into by India with say any other country, say Belgium, and I agree for a lower TDS rate of 5%, say in respect of dividend article, then I will also import that lower TDS rate or taxability rate of 5% even for India, Portugal, DTAA. So by virtue of this MFN clause, the non-resident which was based out of Portugal, who would otherwise been subject to TDS at the rate 15%, was able to take lower TDS rate or taxability rate of 5%, and the dividend were paid to non-resident of Portugal at the rate of 5%. This issue was taken up right before Supreme Court, and Supreme Court said that this interpretation holds good only in a situation where the treaties have been subsequently modified. So in Nestle India, what had happened that because of MFN, the non-resident took recourse to a lower rate, but sadly in that state, in that case, the treaty which India had entered into was not notified by the government, and court said because it is not notified, the benefit of MFN will not be available to the non-resident.
So we have a next question also. Digital Form 10F is widely provided by the foreign suppliers and a question mark.
Yeah, it is widely provided by the foreign. Initially, there were challenges in provision of Form 10F because one was required to create a login ID, and for that it required permanent account number. But now the need to obtain a permanent account number has been done away with. Form 10F has been a simpliciter form which contains very basic details, and it is easy to file the digital forms.
I'm just checking the chat box also. It's, yeah, no questions there. Yeah, the question just now you answered has a thanks to you, sir.
Yeah. Thank you.
So, Chanchalji, are there any other questions? Have you covered?
I don't think so, sir. The Q&A is all answered and no questions pending.
Okay, then, Ketan sir, you have anything to share with us?
No, I think fantastic session all in all by Bhavin. And, you can give your closing remark and request CH Chanchal madam to give a very well-deserved vote of thanks.
Chanchal ma'am, before we go for the vote of thanks, there are two announcements from my side. I would like to remind all the attendees that the next session of this series will be on 16th September, and the topic will be transfer pricing challenges and solutions. And the learned faculty who is going to deliberate on this topic is C. Akshay Kenkre. Apart from that, tomorrow we have Samvad Vishwas Ka. Every 10th and 24th of every month we virtually meet, and tomorrow 4 to 6 that session also will be there, question answer session. So I'll request all the members to attend that also, so that though question will not is not from your side, but there are many questions which may enlighten you or may help you in your day-to-day practice. So please attend. Over to you, Chanchal Jain ma'am.
Thank you.
We can present vote
Yeah.
of thanks.
Thank you so much.
Presentation, somebody's asked presentation. Presentation will be uploaded on WRC's website. Once the speaker will provide, maybe in few days you will see it is posted on WRC's website.
Even I wanted to ask for the presentation. It was a very wonderful one.
I'll share in a couple of days' time.
Yeah. Thanks so much. So I am so honored by WIRC to take this privilege to give a vote of thanks to such a wonderful speaker. I mean, I did not know that 195 section is such, it can be explained in such a lucid way. Because the moment 195 comes to mind, it's like a very burning issue. And just simplified way, the way you have taken it, it can just show that how expertise and knowledge base you must be having on the topic, along with all the case laws and the principal purpose test, poem, and the MLI provisions. They were so, woven into the entire presentation that we didn't feel that we are learning the topic as if in an isolation.
Thank you.
So your ability to break down this intricate tax concepts into easily digestible insight has been truly amazing. And I'm sure everybody would have got benefited from this wonderful deliberation of yours. And I am so thankful to the organizers and WIRC with a very dynamic leader, CA Ketan Sarji, to getting a wonderful speaker on this topic and enlightening all the fellow members on this wonderful topic. Thank you so much. And Dedhia sir, I'm so lucky to introduce you also and give a vote of thanks to you. Thank you so much.
Thank you so much.
Same way, even video, YouTube video with the consent of the speaker, somebody's asked, we will definitely upload on WRC's YouTube with the consent of Bhavin bhai.
Yeah, sir. All yours.
Happy learning to all of you. Thank you very much
Thank
for
you.
Thank you
Thank you.
everybody. Thank you Bhavin bhai. Thank you
Thank you,
Chanchal
sir.
madam.
Thank you,
Thank you
everyone.
Sanjay bhai.
Thank you so much.
Thank you.